Did you know that since inception, JEPQ, known as JEP, has paid out 35.7% in dividends on a $50,000 investment? It's also gained 23% on market share increase. But has it really been a winning investment? Let's break down the numbers. Welcome back to Simply Money. Today we're going to be looking at our $50,000 JEPQ investment and seeing with the latest update on the dividend payout and where we stand. We're going to look at the ups and downs. We'll see where we began, where we've come from, and the cumulative increase in both dividends and market share valuation. So join me as we dive into these numbers today. Just as a quick recap, what I've done is I've taken JEPQ and I've put in a $50,000 hypothetical investment. And we've been looking at month to month how this has grown. We look at the dividend, how much the dividend has increased or decreased. We also look at the stock price, the share price of JEPQ, and seeing how it is also growing, and to determine whether this is something we want to invest in long term. And I will give you my rationale why I hold a small portion of JEPQ in my portfolio and the impact it will have when I decide to go financially independent and no longer work, and the income-driven portion of that and what it means to me. Again, this is not financial advice. I'm not telling you to buy JEPQ. This is for educational purposes only, and for you to be able to see and look back in hindsight and to show what JEPQ has done to determine if it's something we want to hold going forward. Now, JEPQ is simply a covered call ETF. It's comprised of a lot of tech stocks. There's a lot of volatility, but with covered calls, they're also driving to get you dividends. And this is really the essence of this. This is an income-driven ETF. It caps its upside because of the covered calls. You're not going to get as much upside if you had just a regular ETF that had these same stocks in it. But it also allows you to drive income to be able to have that income coming. And for a lot of people, what you can do is, if say you're living off of your portfolio, you have this 9 or 10% dividend being paid out to you, that can be income that you're using to help pay your bills. Now, if you're not needing that income, you can keep the DRIP on, the dividend reinvestment plan, where you automatically reinvest the dividends and buy more of the share. And we'll look at that, how that works. Every time the dividend is paid, you get that dividend and it automatically buys as many shares of JEPQ as you can based on the current price. Something else you can do, though, is you can not have DRIP on, have that dividend paid into your investment account, and then you can repurchase other investments with that. For example, let's say you get your dividend from JEPQ and it's $500, and then you have that go into your brokerage account, and then you reinvest that yourself. Instead of being dripped into automatically buying more JEPQ, you go and purchase. Let's say you want to buy FXAIX, an S&P 500 index, or whatever you want to buy. It's driving income for you to be able to purchase more of something else as well. So there's different ways you can go about that. What we've done in this portfolio is simply reinvest it buying more to show the snowballing effect of dividend reinvesting. Looking on our chart, you can see we have JEPQ initially bought September 1st, 2022. We're about 2.5 years into this portfolio. We invested $50,000 at $45.64 per share, which got us 1,095 shares and then some change. Again, so that's our $50,000 initial investment. The first dividend was paid immediately September 7th, 54 cents per share. So that was a $591 dividend payment. With the price of $45, we were able to purchase almost 13 more shares of JEPQ. And you can see with the price increase of a few cents, the dividend reinvestment, our portfolio after 7 days is now up $700. Again, we're not looking at this for 1 month, 2 month things. We're not looking at it even for 1 or 2 years. But we're tracking this on a long term to see how it impacts in showing the growth. And I want you to look at some of the other videos. Check out the one we did on SCHD, which is a dividend growth ETF that pays a lower dividend, but the growth of the dividend is what's so valuable in that. And compare the two and see how one operates versus the other. This, you're going to get an initial higher payment but will it outlast and will it grow faster than something like SCHD with its compounding of that CAGR? A couple things I want to point out real quick. As you look on the chart here, you can see that the dividend in September was 54 cents, then 37, 68, 54, 57, 44. You can see that there's not necessarily an upward trajectory of how much the dividend pays. The percentage is sticking around the 8.5 to 10% range based on the share price, because you can see the share price is a little up and down as well. You have $45, went down to $40. Here we get up to 48 a year later. My point on sharing this is understanding that a covered call ETF like this, the purpose of it is to get some cash generated. You have to understand the reason you want to do that. If you don't understand why that is valuable and how that can impact you positively in your portfolio, you need to do more research before you even look at covered calls. Two things I want to point out. You can see the dividend per share, how it is up and down. It's not a consistent year over year higher than something like SCHD, where you might have quarter to quarter that one's down a little bit, but year over year, it's been up every year, and over 10-year average up 10%. Where this, you can see, was 54 cents, and then we can go down 2 years later, and it's only 56 cents. Now we're going to look at the most current one, March of 2025, and we see that it's only 48 cents. 2.5 years later, the dividend is actually smaller. There's been some that are a little bit higher, but this isn't about dividend growth. This is about immediate cash flow. That's the purpose of this. And so you have to understand this is not going to keep up with inflation when it comes in a inconsistent manner like this, but it's a high starting yield. And so if you're needing some cash flow through that and you're investing to get some cash flow, but let's look at this real quick. As you can see, over the course of a few years, the dividend payment the first month was almost $600, and it went down to $410, $760. We can skip down here. We can see hasn't been $700 again until 2 years later. This isn't the consistency that a lot of people need with dividends. A lot of people, especially if you're in retirement, you need a consistent, if not consistent, growing, and this isn't necessarily going to be that for you. But you can see as you're getting this dividend and you're buying more shares. Remember, we started out with 1,095 shares, and we go through each month. You can see how many shares we bought based on the dividend, the price, and how many shares we got. Over the course of this 2.5 years, we've gained 362 more shares. So there's where the power of that rolling it back in. The dividend's not necessarily increasing, but you're getting more shares, so then you're getting a higher dividend payment off the same investment. You can see our latest of 48 cents paid us just under $700 for the month, and we're able to buy 12.5 more shares. The other thing is the value has gained $30,000. That's by reinvesting those dividends, and it's getting more shares, and the share price increasing 22%. Now, over 2.5 years, that's not phenomenal growth. That's around 8% share growth price per year over this couple years. It's not phenomenal, but it's still good. But when you add that in the dividend payment, we've received almost $18,000 in dividend payments off of that $50,000 investment in 2.5 years. We've received a 35.71% return simply on dividends. We add that together, we have a total growth of our initial investment of 63% over 2.5 years. So that is a really good growth rate, and that is something to look at, and that's that snowball impact. You have to decide what it is you're looking for, and I like this currently for what it's doing for my portfolio and allowing me to reinvest that the way I want to. Again, you have to decide. Think about the cumulative shares. You now have 1,458 shares. You've gained, again, 362 shares by buying more dividends. When you go to sell, if you decide to sell shares, you have more shares to sell. And because I like this growth, it's not phenomenal growth, but it is growth while you're buying more shares. And you're being able to buy at lower cost because this isn't growing so fast that when you get the payment, you can see you're averaging 11, 12 shares repurchasing every month. And this is a month payout, not a quarterly payout. So you're really rapidly increasing the amount that you're repurchasing, and it's a great short-term way to build a portfolio and cash flow for whatever reasons you may have, whether it's to live off of, to buy other shares of something else, whatever you decide and how you want to use it. What are your thoughts with JEPQ? Do you own JEPQ? If you have, how long have you held it? And are you satisfied with what you're seeing? If not, what is it that's keeping you from JEPQ? Why don't you like JEPQ? And again, this isn't me promoting to get JEPQ or not to get JEPQ. Everyone has to make their own decision. This is a small percentage of my portfolio. I have a couple large holdings of ETFs that I put a lot of my investment in. And I have some small holdings that I have for various reasons that I'm doing that. And that's my decision, what is working best for my investment plan. You have to decide for yourself. Maybe you don't own JEPQ. Do you own JEPI? Do you own QILD? Is there another covered call ETF that you own? And if so, why did you pick that one versus the other? Share that in the comments below. So that's it for today. Our update on JEPQ and March 2025 dividend of 48 cents and how that's impacting our $50,000 initial portfolio investment. I appreciate you joining me here on Simply Money. Don't forget to hit that like and subscribe button. Hit the bell for notifications of future videos, and we'll see you next time on Simply Money.